All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another financial doom narrative designed for clicks. This is about a regulatory framework that went into effect on January 1st, 2026, that fundamentally changed the relationship between you and your savings. I'm talking about the Basel III Endgame regulations that were finalized by the Federal Reserve, the Office of the Comptroller of the Currency, and the Federal Deposit Insurance Corporation in December 2025. And if you don't understand what this means, here's the bottom line. Under these new capital requirements, banks are now incentivized to punish savers and reward borrowers in ways that most people will not recognize until it's far too late. Your savings account, the money you think is safely earning interest and building wealth, is now being systematically devalued through a combination of negative real interest rates and regulatory mechanisms that treat your deposits as a liability to be minimized, not an asset to be rewarded. This isn't coming. It's already here. The regulatory text was published in the Federal Register, the compliance deadlines have been set, and the largest banks in America, J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup, are already restructuring their balance sheets to adapt to this new reality. And here's what's critical. We are now in a macro environment where savers are being explicitly targeted as the shock absorbers for a financial system that is drowning in debt and cannot afford to pay market rates on deposits. Global debt to GDP is at 336%. Central banks are trapped between crushing inflation and triggering insolvency across the banking sector. And the traditional tools of monetary policy have been exhausted. That means the next phase of this crisis will not be solved by rewarding prudent savers. It will be solved by transferring wealth from savers to borrowers, from creditors to debtors, and from the responsible to the reckless. In this video, I'm going to walk you through exactly how the Basel III Endgame works, why it mathematically punishes savers, and most importantly, what you can do right now to protect your wealth and position yourself asymmetrically before the majority of investors even understand what happened. By the end of this video, you'll have a clear action plan. So stay with me because this is not a drill. Let me introduce you to a framework that will help you understand everything we're about to discuss. It's called the asymmetric wealth transfer model, and it's the only rational lens for viewing systemic financial regulation in an era of unprecedented debt overhang. Here's how it works. In a normal economic environment, savers are rewarded for deferring consumption. You put money in a bank, the bank pays you interest, and that interest compensates you for the risk of lending your money and the opportunity cost of not spending it today. But we are not in a normal environment. We are in a regime where the rules themselves are being rewritten to solve an impossible equation. Governments have borrowed more than they can repay. Banks are holding assets that are worth less than their liabilities. And the only way out without triggering systemic collapse is to slowly, quietly transfer wealth from those who saved to those who borrowed. The asymmetry comes from understanding that this transfer is not random. It follows a specific mechanism embedded in regulatory policy, interest rate suppression, and inflation. And if you understand the mechanism, you can position yourself outside of it. The thesis of this video is simple. The Basel III Endgame regulations have restructured bank capital requirements in a way that makes retail deposits more expensive for banks to hold. This creates a direct financial incentive for banks to lower deposit rates, push savers into riskier products, and reduce the total amount of deposits on their balance sheets. At the same time, inflation is running above the interest rates being paid on savings accounts, which means real returns are deeply negative. The result is a quiet wealth tax on savers that most people will not recognize until years of purchasing power have already been destroyed. But here's the opportunity. Those who understand this shift and move their wealth into scarce hard assets that cannot be debased or diluted will not only protect their purchasing power, but position themselves to benefit from the largest wealth reallocation in modern history. This isn't about timing the collapse. It's about understanding that the rules have changed and playing a different game entirely. So let's break this down, starting with history, because this exact playbook has been used twice before, with devastating consequences for savers and life-changing gains for those who positioned correctly. The first historical parallel we need to examine is the period immediately following World War II, from 1945 to 1955. Most people don't realize that the United States emerged from World War II with a debt-to-GDP ratio of 119%, higher than it is today. The government had borrowed massively to fund the war effort, and the question was how to pay it back. The answer was financial repression. The Federal Reserve and the Treasury coordinated to cap interest rates on government bonds at artificially low levels while inflation was allowed to run. This created a period of deeply negative real interest rates that lasted for nearly a decade. If you held a government bond paying 2.5%, but inflation was running at 4 to 6%, you were losing purchasing power every single year. Over the course of a decade, the real value of government debt was cut nearly in half, not through default, not through austerity, but through inflation. And who paid for that? Savers, bondholders, anyone who trusted the system to preserve their wealth in nominal terms. The people who understood what was happening moved their wealth into real assets: farmland, industrial real estate, commodities and equities in companies with pricing power. Those assets appreciated in nominal terms faster than inflation, which meant they preserved and grew purchasing power. The lesson from the post-war period is clear. When governments are drowning in debt and cannot afford to pay market interest rates, they will always choose to inflate the debt away, and savers will always be the ones who pay the price. But the investors who recognize the pattern early and reposition into hard assets come out ahead. The second historical case is the stagflation crisis of the 1970s, and this one is the most direct parallel to what we're entering right now. In 1971, President Nixon closed the gold window, severing the last link between the dollar and any form of hard money. What followed was a decade of monetary chaos. Inflation hit 14% by 1980. Interest rates on savings accounts and certificates of deposit were capped by Regulation Q, a federal rule that prevented banks from paying competitive rates to depositors. So even as inflation was destroying purchasing power at double-digit rates, savers were legally prohibited from earning market returns. If you had $10,000 in a savings account in 1971 and you left it there through 1980, the nominal balance might have grown to $12,000 or $13,000. But in real terms, adjusted for inflation, your purchasing power was cut by more than 50%. You lost half your wealth by doing what you were told was the safe, responsible thing. Meanwhile, gold went from $35 per ounce in 1971 to $850 by January 1980, a 24 times return. Silver went from $1.50 to $50. Real estate, commodities, energy stocks, anything with tangible value and pricing power exploded. The investors who understood that Regulation Q was a wealth confiscation mechanism disguised as stability and who moved out of cash and bonds into hard assets didn't just survive the decade, they became wealthy. The lesson from the 1970s is that regulatory caps on interest rates in an inflationary environment are a direct tax on savers, and the asymmetric move is to exit the system entirely and hold assets that cannot be capped, controlled, or devalued by policy. Now let's bring this into 2026 and talk about what's happening right now, because the Basel III Endgame is the modern version of financial repression, and it's more sophisticated than anything we've seen before. Basel III is an international regulatory framework for bank capital requirements. The goal, according to regulators, is to make the banking system safer by requiring banks to hold more capital against risky assets. That sounds reasonable on the surface, but here's the mechanism that matters. Under the new rules, banks are required to hold significantly more capital against certain types of assets, including mortgages, corporate loans, and even retail deposits. For every dollar of deposits a bank holds, it now has to set aside more regulatory capital to satisfy Basel III requirements. This makes deposits more expensive for banks. And when something becomes more expensive, basic economics tells us that demand for it goes down. So what are banks doing in response? They're lowering the interest rates they pay on savings accounts and checking accounts to discourage deposit growth. They're pushing customers into investment products, brokerage accounts, and annuities that don't count as deposits on the balance sheet. And in some cases, they're outright turning away large depositors or charging fees for holding excess cash. This is not conspiracy. This is disclosed in the earnings calls of every major bank. JP Morgan's CFO explicitly stated in their Q4 2025 call that deposit pricing would remain suppressed due to the higher capital costs under Basel III. Bank of America's CEO said they are focused on optimizing deposit mix, which is banker speak for getting rid of expensive deposits. The regulatory framework has created a structural disincentive for banks to reward savers, and that disincentive is now showing up in the real economy. Now let's layer on the second part of the equation, which is inflation and negative real rates. The Consumer Price Index, the official measure of inflation, showed an annual rate of 3.4% as of December 2025. But anyone who buys groceries, pays rent, or fills up a gas tank knows the real number is higher. Shadow Stats, which calculates inflation using the 1980s methodology before the government changed the formula, puts real inflation closer to 7 to 9%. Let's be conservative and use the official 3.4% number. Now look at what the largest banks are paying on standard savings accounts. Chase Savings, 0.01%. Bank of America Savings, 0.01%. Wells Fargo savings, 0.01%. Even the high-yield online savings accounts that were paying 4 to 5% in 2023 have now dropped to 3.5 to 4%. If you're earning 4% on your savings, but inflation is running at 3.4% officially, your real return is 0.6%. If the real inflation rate is 7%, you're losing 3% per year in purchasing power. Over a decade, that's a 30% haircut in what your money can actually buy. This is the quiet mechanism of wealth confiscation. It doesn't require a policy announcement. It doesn't trigger protests. It just slowly, methodically destroys the value of cash and savings while most people assume they're being responsible. Now, let me show you how this connects to the bail-in framework, because the two systems are designed to work together. After the 2008 financial crisis, regulators implemented something called the Orderly Liquidation Authority under Title II of the Dodd-Frank Act in the United States. The equivalent exists in Europe under the Bank Recovery and Resolution Directive, in the UK under the Banking Act, and in Canada under the bail-in regime that went into effect in 2013. Here's how it works. In the event of a bank failure, instead of the government bailing out the bank with taxpayer money, the bank bails itself in by converting the liabilities on its balance sheet into equity. That means bonds get haircut, shareholders get wiped out, and deposits above the insured limit, that's anything over $250,000 in the US, get converted into shares of the failed or restructured bank. You go from being a depositor with a claim on cash to being a shareholder in a potentially worthless institution. This was tested in Cyprus in 2013, where depositors lost up to 47.5% of their uninsured deposits overnight. It happened in Italy in 2015 with 4 regional banks. It's embedded in the legal code of every G20 nation. Your deposits are no longer your money in the way your grandparents understood money. They are unsecured liabilities on a bank's balance sheet, and in a crisis, you are last in line. Now combine Basel III, which makes deposits expensive for banks, with the bail-in framework, which treats deposits as loss-absorbing capital, and you see the full picture. The system is being architected to discourage savings, to push people out of cash, and to harvest whatever remains during the next crisis. So what are the 3 asymmetric plays that allow you to not only protect yourself, but position for what's coming? The first is physical precious metals as the ultimate savings vehicle outside the banking system. Gold and silver are the only assets that are simultaneously liquid, portable, have zero counterparty risk, and cannot be debased by central banks or seized through bail-ins. Right now, gold is trading near $2,650 per ounce. But in real terms, adjusted for the actual growth in money supply since 1980, gold should be trading above $4,000. Silver is even more compelling. The gold to silver ratio is currently sitting at 88 to 1. The historical average over the last century is 60 to 1. That means silver is undervalued relative to gold by nearly 50%. And when you factor in the industrial demand from solar panels, electric vehicles, and defense applications, the supply deficit is structural. Silver inventories at the COMEX are at multi-decade lows. Physical demand is outstripping mine supply by over 200 million ounces annually, and the price is still being suppressed by paper derivatives that trade at 100 times the physical supply. When that paper market breaks, and it will break when enough people demand physical delivery, the reset in silver price will be vertical. The move here is simple. Allocate a minimum of 15 to 25% of your liquid net worth into physical gold and silver that you hold in your possession or in fully allocated, segregated storage outside the banking system. Not ETFs, not mining stocks, not unallocated pool accounts, physical metal. The second asymmetric play is senior precious metals producers and royalty companies with Tier 1 assets in safe jurisdictions. These are leverage plays on the underlying metal price. Historically, in a gold bull market, the senior miners outperform the metal by a ratio of 3 to 1 or higher. Companies like Newmont, Barrick Gold, Franco-Nevada, and Wheaton Precious Metals have strong balance sheets, low political risk, and diversified production profiles. When gold moves from $2,650 to $4,000, which is entirely plausible given the monetary backdrop, a miner with all-in sustaining costs of $2,300 per ounce sees their free cash flow explode, and the market values these companies on multiples of cash flow. So a 50% move in gold can translate into a 150 to 200% move in the equity. The risk here is operational, which is why you focus on quality, but the asymmetry is undeniable. The third play is real assets with intrinsic value and pricing power. This means productive agricultural land, energy infrastructure, water rights, timber, assets that generate cash flow independent of the financial system and that retain value in an inflationary environment. These are not liquid. They require capital and active management. but they are the assets that the ultra-wealthy, the families that have preserved generational wealth through multiple currency crises, have been accumulating quietly. The Rockefellers, the Rothschilds, the sovereign wealth funds of the Middle East, they're not holding savings accounts. They're holding land, resources, and hard collateral. You want to be on the same side of the trade as the people who understand how this game actually works. Now let's talk about what you need to do right now, because understanding the thesis is only half the equation. First, you need to audit your current allocation. Add up every dollar you have in savings accounts, checking accounts, money market funds, and short-term bonds. If that number is more than 50% of your liquid net worth, you are overexposed to the wealth confiscation mechanisms we've discussed. The action is to immediately move a portion of that into physical precious metals. Start with 15%. If you understand the asymmetry, push it to 25%. Work with a reputable dealer like APMEX, SD Bullion, or JM Bullion. Take physical delivery or use a fully allocated storage solution like Brinks or a private vault in a stable jurisdiction. Avoid numismatic premiums and collectible coins. You want bullion, bars, and recognized sovereign coins like American Eagles, Canadian Maples, or South African Krugerrands. Second, you need to reduce your exposure to long-duration fixed income. Bonds and bond funds are a guaranteed loss in real terms in a financial repression environment. If you're holding 10-year treasuries yielding 4.3% and inflation is running at 7% real, you're losing 2.7% per year for a decade. That's a 27% destruction of purchasing power. The move is to rotate into shorter duration, inflation-protected securities like TIPS, or better yet, exit fixed income entirely and move into hard assets. Third, if you have more than $250,000 in any single banking institution, you are holding uninsured deposits that are explicitly at risk in a bail-in scenario. The solution is to either spread your deposits across multiple institutions to stay under the FDIC limit or, and this is the better move, convert those excess deposits into physical assets that sit outside the banking system entirely. The wealthy are not keeping millions in checking accounts. They're holding metal, land, art, anything that has intrinsic value and cannot be bailed in. Fourth, you need to build jurisdictional redundancy if you have significant wealth. This means offshore accounts in jurisdictions with strong property rights and no bail-in legislation, at least not yet. Switzerland, Singapore, and certain Caribbean jurisdictions still offer privacy and asset protection that no longer exists in the US or EU. This is not about tax evasion. This is about not having all your eggs in one legal and regulatory basket. When capital controls are implemented, and they will be implemented during the next crisis, they happen within jurisdictions. If all your wealth is domiciled in one country, you have concentration risk that is entirely avoidable. Fifth, and this is critical, you need to educate yourself continuously because the regulatory environment is evolving in real time. The Basel III Endgame is just one piece of a larger architecture that includes central bank digital currencies, the elimination of cash, and the integration of financial surveillance into every transaction. The Bank for International Settlements published a working paper in October 2025 outlining how CBDCs can be used to implement negative interest rates directly on consumer deposits, something that was impossible with physical cash. The European Central Bank is already piloting a digital euro with programmable features. The Federal Reserve has a FedNow system that lays the groundwork for a digital dollar. When these systems go live, the ability to opt out, to hold cash under a mattress, to move money without permission, disappears. And your savings become fully conditional, subject to surveillance, taxation, and confiscation at the push of a button. The time to position outside the system is now, while the exits are still open. Here's the question I want you to answer in the comments, because I want to know where this community stands. What percentage of your net worth is currently in physical gold and silver? And if it's less than 10%, what's stopping you from increasing that allocation? Is it skepticism about the thesis? Is it lack of knowledge on how to buy and store? Is it liquidity concerns? I read every comment, and the collective intelligence of this audience is one of the most valuable aspects of this channel. So let me know where you are and what obstacles you're facing. And if you found this breakdown valuable, if you understand that the Basel III Endgame is not just a technical regulatory change, but a structural mechanism that turns savers into losers, then I need you to do two things. First, hit that subscribe button and turn on notifications, because this channel exists to connect the dots that the mainstream financial media will never touch. We go deep, we go early, and we focus on actionable intelligence that you can use to protect and grow your wealth in an environment that is designed to destroy it. Second, share this video with anyone you know who has significant savings in the traditional banking system. The people who are going to be hurt the most by this quiet shift are the ones who don't have access to this information, who trust that the system will reward responsibility, and who will wake up in 5 years and realize their purchasing power was cut in half while they were sleeping. This is not about fear. This is about preparation, and preparation is what separates those who preserve generational wealth from those who watch it evaporate in real time. The regulation change is final. The wealth transfer has already begun, and the only question left is whether you're going to recognize it in time to act or whether you're going to be one of the savers who becomes a loser. Take action, stay informed, and I'll see you in the next one.